For example, today you went to a shop that does not have fixed prices, right? So you'll go there and they say, hey, I need this particular book. Then they will tell you this book goes for 1,000. And when they tell you that the book is going for 1,000 Kenya shillings, you'll tell them, no, the money that I have currently is 800. So should they give you this book for 800, then automatically it means that you've bargained, you've discounted. Now, ladies and gentlemen, a discounted amount is basically a lower amount. In finance, and listen to me very carefully. In finance, if somebody promises you, for example, 10 million Kenya shillings in 5 years' time, somebody promises you 10 million Kenya shillings in 5 years' time, the equivalent of that money today will not be 10 million. In terms of today, whatever 10 million will be able to buy in 5 years' time, all right? Ladies and gentlemen, listen to me very well, and I'm so happy because I'm now seeing the numbers are increasing. There is what we call time value of money. Time value of money. So for us, what you're supposed to know, ladies and gentlemen, is that when we talk of discounting, basically discounting techniques are techniques that are used to evaluate, to determine the present value of cash flows. So tell us there that these are techniques. These are techniques that are used to ascertain present values of future cash flows. Present value of future cash flows. Present value of future cash flows, Now, ladies and gentlemen, it will be very important for us to mark at this particular point in time that there are two types of cash flows. There are two types of cash flows. Number one, we have what we call irregular cash flows, and then number two, we have what we call the regular cash flows. So we have irregular and what here? Regular cash flows. So we have irregular cash flows and the regular cash flows. Very important for us to be able to master this from the word go. So we have irregular, and then number two, we have what we are calling regular. Now, ladies and gentlemen, as I strive to put my case forward, whenever you hear of irregular cash flows will be discounted using PVIF. Just write it like that. But irregular cash flows will be discounted using PVIF. And then regular cash flows will be discounted using the famous PVIFA. So anytime we talk of irregular cash flows, you discount them using PVIF, and regular cash flows, you discount them using the famous PVIFA. So PVIF stands for what, ladies and gentlemen? PVIF stands for present value interest factor. Present value interest factor, with the PVIFA standing for present value interest factor of an annuity. Present value interest factor over an annuity. Present value interest factor over an annuity. So can I kindly know whether we are together up to here? Is there somebody who can, in this case here, tell me whether they have been able to write, first of all, up to here? This is so important to me as I put down my foundation for purpose of doing a past paper question. You can't miss a past paper question. You can't miss an exam question, this exam coming. You can't miss a question on NPV, payback period, discounted payback period, IRR, And all those particular models that I'm mentioning here, of course, they need what here? Enough knowledge of discounting, So I would want to know whether we are together up to here. Have you guys been able to write up to here? And as I wait for you guys to give me response, the most important thing is for us to know that irregular cash flows, they keep on fluctuating. This year you are getting 10, next year you're getting 15, the other year you're getting 8. So in this case here, irregular means what here? Non-uniform. And if the cash flows that you give me are non-uniform, then I will always discount them. I'll always present value them using PVIF, present value, interest factor, And if, for example, the cash flows that I'm getting here, ladies and gentlemen, are regular, like this year you are giving me 10, next year 10, the other year 10, the other year 10. So if it is 10, 10, 10, then we call them uniform. Uniform are also called what here? Annuity. And if there are annuities, then automatically we shall be using what we call PVIFA. Sorry, here I left an A. So this is supposed to be PVIFA, which is present value, interest factor of an annuity. Now listen and listen to me very well. Ladies and gentlemen, when we talk of PVIF, this PVIF that we have been told what it stands for in full, I'm supposed to remember very fast that PVIF, the formula is 1 plus R raised to negative N. Anytime they want us to give them PVIF, it is 1 plus R raised to negative N. This is a very important formula where R is the COC. COC is cost of capital. N is a number of years. And then, ladies and gentlemen, when we talk of PVIFA formula, of course, you'll be able to read these figures. Some of these figures, you'll be reading them from some tables that will be given to you, but it's also very important for you to get to what are the formulas. Now, listen, when it comes to PVIFA, what we do, we say 1 minus this smaller formula. 1 minus this smaller formula, which is 1 plus R raised to negative N, and then everything. You divide everything by R. This is supposed to be a normal R. My handwriting is very bad. Don't write this R in a funny way. You need to write this R in a better way. So anytime they talk of PVIFA, what am I selling to you here today? Anytime I talk of PVIFA will be 1 minus this simple formula all over R. Very important. And then how do we apply this in our exams? So in our exams, this is what will happen. What will happen? These guys, of course, if you get a lazy examiner, a good examiner can't give you cash flows directly. If you get a bad examiner like myself here, I can never give you cash flows directly. What I will do, I'll give you like sales, variable cost, fixed, and then I ask you to get cash flows yourselves. But if you get a lazy examiner, this lazy examiner will give you cash flows. For example, these are 10, 12, 8, for example, 9. And then they'll come and tell you that the initial cost of the machine is maybe 15, and then they'll come and tell you that the cost of capital is 10%, And then you are required to determine net present value. So they have given me cash flows. These cash flows are futuristic. Remember, today we are at time zero. So then we shall get, if we invest in this machine, end of year 1, we get 10. End of year 2, we get 12. End of year 3, we get 8. End of year 4, we get what year 9. And then they have given us the initial cost of the machine is 15. The cost of capital is 10%. Then they want us to do something very easy to determine the net present value. We determine the net present value. Rule number 1 of finance. These future cash flows, we must get them from the future. We bring them to today. We must discount them. To discount them, then, we must appreciate which kind of cash flows do we have today. The cash flows that we have here are irregular. They are wobbling. They're dancing. Today, I'm getting 10, other 12, 8, 9. So if they're irregular, then to discount them, I shall use what we call PVIF. I shall use what we call PVIF. So under PVIF, this is how we now apply the PVIF. These are the cash flows that we have here. These are the cash flows that we have here. And then now I'll come and create a discounting formula here of PVIF. And the formula of PVIF is like this. It is 1 plus R raised to negative n. This R is the required rate of return, is the return given in the question in form of percentage. It will be the COC, cost of capital, cost of capital. Fortunately, the cost of capital has been provided in the question here. It is here. The capital providers need a return of 10%. The capital providers need a return of 10%. So R has been defined. And you see 10% is the same as 0.1. 10% is the same as 0.1. 10% is the same as 0.1. So when I come here getting PV, ladies and gentlemen, then I'll write here 1.1 or 1 plus 0.1 raised to negative 1 because n is the time period. These are the years. These are the years. Then I go to the second one and say 1 plus 0.1 because the cost of capital does not keep on fluctuating. The cost of capital does not keep on fluctuating. So 1 plus 0.1 raised to negative 2. 1 plus 0.1 raised to negative 3. 1 plus 0.1 raised to negative 4. I'm basically following the time period like that. So without using your tables, you know, I've been an examiner of these papers here for so long. And I know the techniques that we as examiners use to put students under the bus. So if I want to put very many students under the bus, I would always give them a cost of capital percentage, which is not on their tables. And then most of them will ring us after exams and they'll tell us, you taught us so well. But when I looked at the percentage given, like 11.5%, it was not in the table. So then what I'll do, because especially if it is towards Christmas festivities, and I will not want to mess their Christmas celebrations, I'll tell them that this was an error by the examiner, just to make them a little bit comfy, you know, right? So they can celebrate. They can celebrate. But I know these are students who never took time to understand their formulas. How does these formulas work? How do they work? So then, ladies and gentlemen, you see this is the same as 1.1. 1.1. So using your calculators, in your calculator, you'll be able to see a sign like this raised. So you say 1.1, this sign raised like that, minus 1, minus 1, minus 1, minus 1. So this is financial management. I think I should have written here, financial management, financial management. I'm representing teacher Collins today. So is there somebody who can give me this first figure? What is 1.1 raised to? What is 1.1? What is 1.1 raised to 1.1 raised to negative 1? Could you kindly give me this figure? 1.1 raised to negative 1. So from BDA class here, my laptop today did something bad and I can't use this particular. So 0.9091. 0.9091. Thank you very much. 0.9091. Thank you very much. I'm so much used to my laptop for teaching BDA. Go to the second one. Go to the second one. 1.1 raised to negative 2. 1.1 raised to negative 2. Is there somebody who can do that thing and give me a figure? So according to Elijah, 0.8264. 0.8264. And then we go to 1.1 raised to negative 3. 1.1 raised to negative 3. Can somebody give me an answer? 1.1 raised to negative 3. So we have here 0.7513. And then the last one, 4 decimal places, you guys are right. Mahabub. When I see this name, I remember a gentleman that I worked with at IGAD. Nice guy. Give me some good consultancy jobs there. So how about this 1.1 raised to negative 4? We have here 6830, 6830, 6830. Now, ladies and gentlemen, when I teach, I expect my students here to be using 2 emojis. These are the 2 emojis that I really love. 2 emojis that I really love. If you're understanding, I expect you to look for an emoji that is smiling. Emoji comes from the word emoticon. Emoticon coming also from emotions. So if you're so happy, you look for that emoji and then you put it there. I'll be able to know that now my students are happy. I need to increase the speed a little bit. And of course, if for some reason you're not able to understand, like how are we getting these figures, it's my responsibility to explain to you how they're being found. That's why I'm the teacher. That's why you guys are paying us fees. So in that case, instead of typing so many things, you'll simply go there and look for an emoji that is like this, a sad emoji. It's like that. When you put it there, then I'll be able to know that this student has a problem. And if possible, you can even look for one that is crying, rivers of tears, crying, saying that now I don't even understand what is happening here. And then I'll be able to jump in and then I help you. And if you don't see this, perhaps you don't have a very good computer, then you can use the thumbs up saying we are okay, or thumbs down to mean that Mwalimu, we have a question. Mwalimu, we have a question. Like now, Oscar, I can see Oscar is so happy, he's laughing. Great, Oscar. So is there any student who has a question now? Is there any student who has a question how you're getting this? Great. These guys are able to see this. Great. We call this present value interest factors. We use present value interest factors when these cash flows are fluctuating. Now, once you have gotten the discounting factors, then I'll have to come and create the last column here. I will have to come and create the last column. The last column will be the column of discounted cash flows. This will be the column of discounted. You write now, this is the column of discounted cash flows. This is the column of discounted cash flows. The column of discounted cash flow. So now we are multiplying, and here we prefer 2 decimal places. So you take a cash flow with its discounting factor, you multiply. Here, don't teach me anything. I know that the first one will be 9.09. The first one will be 9.09 in 2 decimal places. See, how about the second one? So second cash flow, second PV. You multiply the 2 of them, and then you give me an answer in 2 decimal places. You give me an answer in 2 decimal places. You give me an answer in 2 decimal places. Tell me what do we have there. According to Sabrina, 9.92 Olwenyi has also been able to confirm. Thank you so much. You guys are brilliant. I think I need to buy some of you are present today, especially ladies in the house. We need to give them a prize, present. Right? Especially ladies. Why? Because today is a special day for them. It's a special day for them. Which question, Catherine Mova, my friend? We just formulated a question offhand. Yeah, you came a bit late, but all is not lost. This video is recorded. This video is recorded, and normally my recordings, I share them immediately after class. Stakidi na wanafunzi, I share my recordings immediately after class. Hakuna deni na wanafunzi. So start kwa ya 3. So 8 times this figure. What do we have? Abracadabra. 2 decimal places. 2 decimal places. According to my friend Mahabub, 6.01. 6.01. And then now we have the last one. The last one we have 9 times this, which will end up giving me the last one. We have 6. I doubt. Elijah must be answering the cash flow, discounted cash flow for number 3. So according to Elijah, is 6.15. They're quite close. Ladies and gentlemen, what do you know about these discounted cash flows? The discounted cash flows now, all of them belong to the same timeline. All of them are today's cash flow. They have been present values. They've been discounted. They've been removed from the future to today. So if they are on the same timeline, then they are children of the same mother. Now we can add them up. So is there somebody who can give me the total discounted cash flow? Is there somebody who can give me the total discounted cash flow? Is there somebody who can give me the total discounted cash flow? So according to Kinyua Anthony, 31.17. 31.17. So this is the total. Unajua sababu ya usingizi, unajionea mambo mengi sana. Especially the days we used to teach in physical classes. So naambia mwanafunzi sababu ya kuchoka, si mwanafunzi kupenda kuchoka. Unamwambia total cash flow, lakini anaandika total hivi, unaona hivi. Total. No, it is total cash flow, discounted, total discounted cash flow, which is the same as total present value. So is there somebody who can add for us? Is there somebody who can give us the total DCF, total discounted cash flows, which is the same as total present value? Total present value. which is the same as total present value, total present value. So according to Venus, total present value is 31.17. 31.17. Now, once you get the total present value, then the next thing will be for you to come and subtract your cost of the project. You subtract your initial outlay. It's called initial outlay. So come here and subtract the initial outlay. So you less initial outlay. Is there somebody who could remind us? I remember it was 15. The initial outlay was 15. The initial outlay was 15. So then when you subtract, you'll be able to get a surplus or a deficit. You'll be able to get a surplus or a deficit. So 31.17 minus 15 gives me what figure? Gives me what figure? Gives me what figure? Gives me what figure? According to 𝗖𝗙𝗖𝗍𝒂𝒍𝒕𝒉, it is 16.17. Thank you, Elish. Thank you, Lena. Thank you, everyone. Really, you guys are nice. So when I get this figure, of course, this figure is what I'll call the net. It's net of the initial outlay. It's the net present value. And of course, I know there is 1 mark to be earned out of advisory. So when it's positive like that, then we should be able to conclude that this project is viable. When it's positive, you simply come and write here that since NPV is positive, then the project is viable. And you see, just that advisor, that advice statement you've given can give you 1 mark. And you know, in finance, 1 mark is too big. It can make you see places that you've never seen before. That 1 mark can take you to places that you've never seen before. What we call, we shall overcome moment. This one can make you see places, trust you me. So it's positive. So it means that the shareholders will be able to have their wealth increased by this amount. So we recommend the project. We recommend the project. We recommend the project. So that's exercise number 1. So before I go to your past paper, with your permission, I'll be able to formulate a second question. Can we do a second question, or you guys are tired? Can we do a second question, or you guys are tired? Can we do a second question, or you guys are tired? Can we do a second question? Yes, thank you very much. And now in this second question, I'll have a small question that now will move like this. A small question that will move like this. A small question that will move like this. Now we have time. Time 1, time 2, time 3, times 4. Then we have, in this case here, cash flow. We have cash flow. So cash flow is 10, 10, 10, 10, 10, 10, 10, 10, 10, like that. And then I would want us, ladies and gentlemen, to use PVFA. Let it be. I have you will get the video, no problem. Sorry for the inconvenience. We shall overcome. Great. So, ladies and gentlemen, we have 10, 10, 10, 10 there. And then what we happen to be having here is this. What we happen to be having here is this. The cost of capital, the cost of capital, the cost of capital. I love that. Positive attitude. I love that. Great. So the cost of capital, the cost of capital is 10%. Then if it is 10%, I would still want us, there is something I want us to study here, something very important. I know that these are uniform cash flows, but I would want us to treat them as if they are disjointed, as if they are disjointed, as if they are disjointed, as if they are disjointed. I would want us to treat them as if they are irregular. And then if that is the case, then I would want us to come and copy those PVs. Remember, in the other question, we had the PVs with us. So we'd want us just to go there, and then we copy and paste them here. The first one is 0.9091. Is there somebody who can remind us? Is there somebody who can remind us these figures? We are copying and pasting. So copying and pasting from the question above. From the question above. From the question above, end of year 2, what do we have? From the question above, Kinywa Anthony tells me 8264. 8264. Where are these ladies of ours? Where are these ladies of ours who are celebrating this international? 7513. 7513. Thank you so much. And then year 4, lastly, Year 4 lastly, year 4 lastly, year 4 lastly, year 4 lastly, we have 6830. So I know some bright students will ask me, but these are regular now. That I also know that, but there is something that I would want us to experience, a eureka moment, a discovery moment, a discovery moment. So if that is the case, then could you kindly come here and create a column for DCF, discounted cash flows? And this time around, I would want many decimal places. This time around, I want many decimal places. So 10 times this gives me 9.091. 10 times this, it gives me 8.264. This gives me 7.513. This gives me 6.830. And then I would want a bright student, Mwana Inyanya, Women's International Day, and ipatie total discounted cash flow. And ipatie total discounted cash flow. Hii hata staki mambo ya NPV. So hii sina mambo na at initial outlay. Sina mambo na initial outlay. Sina mambo na initial outlay. Nataka tu nipatie total discounted cash flow, tumalizana na wewe. Total discounted cash flow, tumalizana na wewe. Total discounted cash flow, tumalizana na wewe. So according to Kinyua, it is 30, and Lena, it is 31.698. 31.698. This is the total present value. This is the total present value. This is the total present value. So this is the total present value. Thank you, and thank you so much. I would want you to mark this figure because I would want us to apply them in the second method. So method number 2. Method number 2, I love method number 2. How does this method number 2 apply? How does method number 2 apply? Remember when we began this topic, we said we have got two formulas. We have the first formula, which is PVIF, which is 1 plus R raised to negative N. These are formulas that I will never forget. These are formulas that I shall never forget. PVIF is 1 plus R raised to negative N. And then I also went ahead and taught you some important formula that we call the PVIFA for the annuities, for the regular amounts. And we say that for PVIFA, you will always take here 1 minus this smaller formula. 1 minus the smaller formula. And the smaller formula is 1 plus R raised to negative N. So 1 minus the smaller formula, 1 minus the smaller formula. So 1 minus this, and then everything is to be divided by R. Now, my great students, listen and listen to me very well. If I were you, I would have written somewhere here that this is what here, an annuity. This is an annuity. And if I were you, when we write this kind of summaries, if I were you, this is a very important summary. I'll pick the important summary. And then depending on the political party that I find myself in, I will use a highlighter of that color. So depending on the political party or even my tribe, it doesn't have to be political party really, even your tribe. If, for example, you come from a tribe that loves yellow, you get a yellow highlighter, and then you just, that will make this thing conspicuous so that when you are revising, everything becomes what here becomes easy. If, for example, you are an Azimio Damu, no problem. You'll simply buy a blue highlighter and always be using blue. The most important thing is that we need to know how to be highlighting. Now listen, I can see Liz has raised her hand up. Do you want to talk to us, Liz? Can I unmute you? Talk to us, Liz. Perhaps Liz wants to wish Mwalimu a happy Women's Day because, you know, also teachers will give birth. Like myself, I've given birth to many accountants in this country. This is a FM class, yes. This is a FM class. Oh, is that the question you wanted to ask? Yes. Great. We are producing, yes. We are producing accountants, yes. Now, ladies and gentlemen, for this particular question, then, I would want us to calculate PVIFA for this question. Why are we calculating PVIFA? It's because of the 10, uniform cash flows. When the cash flows are uniform 10, then you can't use that other longer approach. You shall be using the PVIFA approach. So then, ladies and gentlemen, let's go ahead and calculate the PVIFA. So this will be 1 minus 1.1 raised to negative 4. Vitu mbili hujaona, hata hujaona nimetoa 1.1 wapi. Let me explain. 1.1 nimechukua 1 plus 10%. Negative 4 because you've got 4 of them. 4 years. Then whatever that I will get here, I will come and divide this with R. My R is constant at 0.1. At 0.1. So here you have to be a bright chap. Why? Because first of all, you must get the numerator uandike kando. So can somebody go there In their calculator, you say 1 minus 1.1 raised to negative 4. Useme equals. Useme equals. Useme equals. What do we have there? (0.9091). According to Lena, I doubt. I really doubt. Please go slowly. Say 1 minus 1.1 raised to minus 4. Raised to minus 4. Raised to minus 4. According to 𝗔𝗖𝗖𝗔𝒂𝒍𝒕𝒉, 0.3169. I think this is correct. 0.3169. And then now, after you get this figure, please divide it with 0.1. Divide it with 0.1. Divide it now with 0.1. Can you kindly go ahead and divide it with 0.1? Can you kindly go ahead and divide it with 0.1? Can you kindly go ahead and divide it with 0.1? Can you kindly go ahead and divide it with 0.1? So when you do like that, according to Veronica, we are getting here 3.169, like that. So I hope now all of us are together up to here. So this is method number 2, very important method. And then for me to be able to get the total present value, then the total present value, I'll pick just 110. 110. Now here I'm using a consolidated PV formula. So I'll use 10, just one of them, times PV_FA. Times PV_FA. So then we have here 10 times 3.169. What figure are we getting at the end of the day, apart from rounding off errors? Apart from rounding off errors, the answer that we get here, will be very close to what we had obtained using the other formula, the one that I told you to tick and remember it. Is there somebody who is able to compare the answer that you're getting here with the answer we got using the other method? Anybody who is able to compare? Don't tell me that, they may be a little bit different. They may be a little bit different, but at the end of the day, we appreciate that rounding off errors will be there. But the thing is, they are the same. The thing is, they're the same. And if they're the same, could you kindly go ahead and tell me which method do you think should we be using? Which method do you think should we be using? Which method do you think should we be using for annuities? The first one or the second one? PV_FA, isn't it? PV_FA, yes. Second method always. Why should we be using the second method? It's because your examiner will tell you 10, 10, 10, 10, up to 50 years. So then tell you 10, 10, 10. If you start using the other long approach up to 50 years, you write so many zeros, 10, 10, 10, 10 as a 0, 0, 0, 0, 50 times, 50 times. And because you have now written so many zeros, then I should be able to give you a 0 in the entire paper. It's a joke, but at the end of the day, whenever amounts given to you are regular, are annuities, then we shall be using PV_FA like that. So the person was cooking ugali. The person was cooking ugali. The person was cooking ugali. Have you finished cooking ugali? Then we shall be able to continue. Great, great. So up to there, yes, whenever a student asks a question, I have to stop recording so that we don't have a lot of interruptions in between. That's why you have to be careful when you are raising your hand. Great. So now we are back to the session. But I would want to ask somebody. Again, I can see Kevin raising his hand. To another. Great. A good question from Felix there. Remember, in financial management, you'll always be given cash flows. If you're given cash flows and the examiner is silent, the cash flows are presumed to be end of year cash flows. They're presumed to be end of year cash flows. If they're beginning of year cash flows, I'll be able to show you the small adjustment, but I'm not yet there. We are simply laying down the ground for all of us. And if you allow me, now I'll be able to look at a different question. So now I would want to assume that we have a great lady here called Beatrice. Assuming Beatrice was to get married to the CEO Safaricom. CEO Safaricom marries who? Beatrice today. And then, you know, these are rich person now because they are paid to the tune of even 20 million a month. These are rich people. So then he makes a promise to Beatrice and tells Beatrice, I'm establishing a fund for you. And this fund is quite a simple fund. It's quite a simple fund that every year you will be getting out of this fund. Every year, Beatrice, because you are a good lady, every year you will be getting a cash flow of 20 million per annum for a period that is unknown, for an indefinite period, where n is infinity. All right. And then he goes ahead and tells you that, you know what, the required return, the cost of capital is, for example, 5%. So Beatrice may want to be valued in terms of this particular cash flow she's receiving. What is our total net worth today? Listen, this 20 million per annum, this is a regular cash flow. A regular cash flow. It's a uniform cash flow. So if it's a uniform cash flow, then the formula that I'll apply here is called the PV. So, and the PV, we've just said it's 1 minus 1 plus R raised to negative n. And then we come and divide everything with R. But you realize that our n here is infinity. And if our n then is infinity, then this n here, if it's infinity, it means that this particular term will be killed. And that is why the formula of PV, whenever n is infinity, is always 1 over what? Is always 1 over R. Is always 1 over R. All right? Now listen and listen to me very well. Where has this 1 plus R going to? It's because if this is infinity, then the entire term here, only this term here, which is raised to negative infinity, will not be defined. If that term is killed, then automatically I'll be left with 1 over this R like that. And then when they want me now to come and give them the total, when they want me to come and give them the total present value, when they want me to come and give them the total present value, what I'll do, I'll take the annuity amount times PV. Now this time round when n is what here? Infinity. So meaning that this will be the annuity amount, which is A times 1 over R. Because now this PV when n is 1 over R, which basically will translate to amount over R. This is a very important formula that I would want you guys to highlight. You don't have to derive it. But when you go to an exam question, and this is quite popular, and then you realize that the examiner is telling you that company A will be receiving 10 indefinitely, then you will remember that the total present value, you will remember, this is so important. If I were a UDA person, what I'll do, I'll come and say here, total present value, when n is infinity, will always be equal to amount divided by R. I don't have to remember any other thing. This is so important to me. This formula I'll have to hide. If I'm a Azimio guy, I'll just whitewash it, no blue wash it. So then the amount here that Beatrice will be getting is 20 divided by R, where R is the cost of capital, which is 0.05. 20 divided by 0.05, like that. And then you will be able to really, you'll be able to do what here to get what answer first of all before I continue. What answer will you be getting before I continue? What answer will you be getting before I... So what is 20 over 0.05? 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 20 over 0.05? 20 over 0. How come they're not giving me answers? Or is there something that is hidden somewhere? 400, Tasneem. 80, is it 80? Please use your calculator, please. Say 20 divided by 0.05. Use your calculator, please. 400. Don't assume, never assume, never assume. So the present value, which this lady has to be very proud of, is 400. So she is worth 400 million today. And this formula is a very important formula to us. This formula. When we continue, assuming that, how about PV when n is unknown? How about PV when n is unknown? If n is unknown, then You know, for PV, how can N really here, Mahbub, not be known? You know, if it's present value interest factor for irregular, you will count. So N will have to be known. N will have to be known. N will have to be known. Great. Now, ladies and gentlemen, please listen and listen to me very well. This formula is so important to me. So important to me because I'll use this particular formula also for valuation of securities. To get value of our securities, we normally say PO equals DO. DO was to grow all over KE minus G. Listen and listen to me very well. Remember this share that you're buying today, you're going to be getting dividends. And the dividends are indefinite. They're indefinite. You can't say that I'll be getting dividends for, they're indefinite. They're indefinite. And because they are indefinite, this is the formula we are using here, that present value, when N is infinity, equals amount over R. But now what happens when there is a growth rate? Because dividends must grow. When there is a growth rate, then this dividend up here will grow. And then, of course, in the denominator, we normally subtract what we call G. These are formula which I'll be deriving later on to be able to fix it with this. Very important formula. And this is how I normally tell my students to cram this formula. You know, if you remember the provincial administration, we used to have like district officer. We used to have like provincial officer. So we normally say provincial officer equals district officer who has to grow in ranks. So when you elevate district officer one rank higher, then it becomes a provincial officer. So provincial officer equals district officer into 1 plus G all over Kenya without government. Thank you so much, ladies and gentlemen. I think if I stop there today, you guys are okay. But I think what we shall do, I'll request your teacher to give me like one lesson whenever he misses, because I'm idle.